Hello guys, welcome back to Wall Street Wizard. Today I am going to explain to you two of the four basic option strategies, which are the long call and the long put. And to put it into better perspective and to understand the whole concept better, we are going to trade a long call and a long put, and I will show you that in a minute. But before that, I will explain to you the basics of how a long call and how a long put work. To explain to you how a long call and a long put work, we will switch to option strat. This tool is very good to illustrate how options work. And the first thing you have to understand for a long call is that a long call is 100% bullish. So the only scenario that you will profit with a long call is that the stock price goes up. To understand this, we are trading a long call for Coca-Cola. Coca-Cola is trading at around $72 at the moment. And we picked out an expiration date of 101 days, or at the 20th of December. We use a strike price of $70.50, and for this long call option we will pay a premium of $270.50, which is also our max loss. This is very important to understand. If you're trading long calls and long puts, the premium is the max loss, so you can never lose more than you paid for the option. So this is why a lot of beginners start trading with long calls and long puts, because it's a very defined risk you're trading with. As you can see, the only way you will profit is if the stock price goes up. In any scenario the stock price goes down, you will lose your money. Which is more interesting is the stock price has to go up a certain amount for you to profit at break even. So your break even price is about $74.68. At expiration, this is important to note, and you can see that in this line. So at expiration, the December 20th, if the stock price is not above that price, you will lose money. And this is important to understand. Options are different from stocks. So if the stock price or if the stock price would rise 4%, you would have made a profit with your stock price. If you're trading a long call and the stock price goes up 3.8%, for example, you will not make a profit with that because you paid the premium for the option. So the only way that you will profit at break even is if it's over the break even price. Of course, if the stock price is rising very fast at the beginning, for example, at the end of December, the price is at $75, you will have, or you will make a profit of around $220. So time is of great importance when you're trading options, or when you're trading options. Now I will explain to you how the expiration date and the strike price will affect the premium of a long call option. If you move down in the time till expiration, the premium will also go down. So pay attention to your net debit you are paying for the long call option as we move down in time. You see that the shorter the time frame till expiration, the cheaper the option gets. This is because the option has something called time value, which I will explain in another video. And if you go up in time, so further out, your premium you will have to pay for the option goes up. It's very logical if you think about it. The less time there is to reach your strike price, the less you have to pay, because it's getting more and more unlikely the less time you have to reach your strike price. For the strike price, if you move the strike price away from the current price the stock is trading at, it will get cheaper. So at $80, for example, the option will only cost around $40. And if we move it below the current price the stock is trading at, so at $70 or at $60, you see that the premium is getting a lot higher. This is because the option has an intrinsic value. What that is, I will also explain at another video. So this is the basics of a long call. Now we can trade this in our account. I will be using a demo account for this example, just so you guys can understand how the option will change over time as the stock price will move. And I already picked it out. It's Coca-Cola. Coca-Cola is trending upward, so it could be a good idea to buy a long call option. And this is what we will do. I already picked out the correct expiration date, 101 days, and we will trade a call at $70.50, and we want to buy the call. So it's a long call, and I will trade it at market. Trading market is not the best way to execute your orders. I'll do it now simply because it's a demo account and I want to get into the trade quickly, so the video doesn't get too long. The better way would be to trade limit and set your limit between these two prices you see here, and try to get the cheapest price you can get. Every trading market will always get executed close to the higher price, so this is worse for us because it's a demo account. It doesn't matter that much. Just keep that in mind. You should always trade with a limit order if you're trading real money. So you can see here the amount we have to pay for the option, and
Order ausgeführt.
We're already in the market. Now to the next step. We will trade a long put on a different stock, which is Coterra Energy, and we will swap again to option strat so you can see how a long put works. So Coterra is already filled in here. We are trading at $22.50 at the moment, and I picked out an expiration date of 130 days away, which is the 17th of January 2025, and we will trade the long put at the strike around of $22, and you see we will have to pay a premium of $120. $120 is also our max loss in this trade, so the same as in the long call. And what is different to the long call is the max profit. The max profit is $2,080 at this example. If we switch back to the long call, you see that our max profit is infinite. Why is that? It's simply because our stock can go to like an infinite number of a price. So Coca-Cola is trading at $72 at the moment, but there's no limit up. So it can trade at 100, it can trade at 500. So theoretically, our long call can profit to infinity, which is very unrealistic, but it is possible. But in a long put, we are expecting the price of the stock to go down. So we only profit if the stock price goes down. And how far down can a stock go? To zero. 0 is as much as a stock price can fall, and you can see if we change the range here to minus 100%, so 0, this is our max profit. It's very unrealistic that this will happen, but yeah, this is our max profit in long put. Also, to illustrate how different expiration and strike prices work out here, it's basically the same as in the long call, just inversed, at least what to the strike price for the expiration. It's the same. The closer we get to expiration, the cheaper the premium will be, and the further out, the more expensive the option will get. And for the strike price, if we move the strike price away from the current stock price, the option will get more expensive because it has an intrinsic value. And if we move it below the current strike price, you see that the premium will go down. Why that is, and how the expiration and strike price and how the option price in general works out, I will explain in another video if you're interested in that. But we will keep it at a simple explanation for now. Now we can trade our long put in our trading platform. So we already picked out Coterra Energy in this case, and we will trade the January 17th put. The put is on the right side, and we want to buy it at $22. So we are buying a long put at a strike of 22. Put it in here. I will trade again market so we get a fast execution. Please don't do that if you're trading with real money. And
Order ausgeführt.
We're in the market, and now we have the two options in our trading platform. Yeah, this is how a long call and a long put work out. These are the 2 of 4 basic option strategies, and I hope you liked the video. If so, please leave a like, subscribe, and share the video. I will keep you guys updated on how the 2 trades work out over time as the stock prices change, and I am happy to see you guys next time. Till then, bye bye.